Ladies and gentlemen, my name is Avi Urban. Thanks very much for attending our presentation on the COVID-19 impact on Silicon Valley real estate. I hope your time will be well spent. Before we dive into the details, and there will be a lot of details, I want to take a second and enjoy this view with you. This is a view of Santa Clara County from Rancho San Antonio, looking at the Bay Area, and we can see the Moffett Field, we can see Palo Alto, Stanford University. That's actually Moffett Field also. And the reason I'm bringing this one up is that my wife and I live in Silicon Valley for the last 35 years. So I love Silicon Valley. Silicon Valley is a very interesting place of a lot of opportunities as well as challenges for quite few. And at the same time, we have the benefit of, beside benefiting from living in this prosperous area, also have a quick access to beautiful parks that I personally, and obviously my wife as well, enjoy very much hiking in those places and kind of decompress of daily challenges and so on. So starting by counting our blessing, we have beautiful weather, a lot of business opportunities and of challenges as well, of course. But nevertheless, as a whole, I love the area and I really believe in its long-term prospects. As far as the agenda of our presentation, we're going to be taking a few minutes to discuss some general stuff. We'll talk about, we have kind of 5 segments in our presentation. The first one is what was the baseline of Silicon Valley prior to the COVID-19? We'll talk about the market during COVID-19. We'll talk about prior crisis, particularly 2 ones back in 2000, the dot-com crash and the financial crisis in 2007. And not that that is something which will repeat itself in the same format, but what can we learn from that events and what can be applied for the future? We'll talk about what can we expect of the impact of this crisis on the Silicon Valley economy and the real estate market. Finally, I'll share with you what are my recommendations, my beliefs, and we'll basically go from there. As far as structurally, for each of those segments, we're going to take about as we mentioned, between 15 minutes plus minus to discuss them. By the end of each section, we will have a 5 minutes Q&A. The end, we're going to have another 5-10 minutes, as long as people are going to stay online and be interested in the conversation to ask questions. And on top of that, at the end of the presentation, we will follow up with a link to the recorded webinar. Anyone who wants and interested to receiving a copy or link to this recorded webinar, please enter in your chat box a personal message to Asaf, the monitor, with your name and email address, so we can send it to you, and hopefully you will be able to benefit from the recording. So you don't have to take necessarily notes right now. You can focus entirely on the presentation. And the last part will be talking about what are the next steps. So a few words about ourselves. I've been doing real estate since 2005. We are lucky to have other members in our group, Asaf, Ella, Nati, and Amit. Each one of them is helping us in different areas of our business. Overall, we are providing those services to our client. So as far as our life in Silicon Valley, where Yael, my wife and I arrived in December 1st, 1985 to Silicon Valley. We were very fortunate. We have actually did plenty of real estate transaction in Silicon Valley and in various other areas of the country. We are very happy with our transaction so far. We'll see how the future will be, but in general, we are happy with that. One of the things that I'm most proud of is the kind of reviews that we are getting from our clients. Everyone is welcome to, and I would encourage any new clients that have not worked with us to take a few minutes and review our review feedbacks or testimonial. And anyone who is planning to work with someone else, I would encourage them to make sure they do their due diligence on the partner they choose before they commit to one. The way we define ourselves as holistic realtors compared to transactional realtors, and what that does basically means that we do not view our relationship with our clients as only help you buy or sell your Silicon Valley home, but we look at basically establishing a long-term relationship that may start with helping you buy or sell your Silicon Valley home, but continues into the realm of investing in real estate portfolio, helping you establish building your net value, as well as your passive income for retirement. And of course, any one of our clients, many clients always have questions about contractors, about refinancing, about trust issues associated with their real estate holding and so on. And obviously we are here for them to help them. So holistic versus transactional, and that's what we are differentiating ourselves and proud about the services we provide to our clients. Now, I also want to invite you to our next week introduction to real estate investing. Those people who have not made investment yet in real estate, we would like to introduce them to this investment class. We talk in general about why everyone should be investing. Obviously, we talk about why in real estate, what are the benefits, what are the drawbacks, and so on. And I want to say something in general. My honest objective of this presentation and any conversation which we have with our client is to be very honest with you and factual. We do not try to hype the market. We try to be objective. We trust that we are dealing with intelligent people, and we want to provide you our experience and expertise so you can make the right decision for yourself. We won't push you. We will not hype any situation. We want to make sure that you are fully aware of the advantages and disadvantages of whatever decision you decide to make. So with that, we're going to now start with actually the focus of our presentation, and that is the COVID-19 impact on Silicon Valley economy and the real estate market. And there is nothing better to start by actually start talking about the timeline. It came obviously the reason why only one can ask, how come we only went into the COVID, the shelter in place in February 25? And that discussion going to continue probably for quite some time. What did we miss? What could we have done better, and so on. But with all that putting aside, let's give the credit where it's due to San Francisco mayor, who actually, and her team, I would imagine, who basically declared shelter in place the first in the country. So I think with this fact, we can see even though that California is the most populous state in the country with approximately 40 million people, the unfortunate number of people who actually have passed away, and each one of them is a life by its own and all that, and family and so on. Nevertheless, though, compared to the size of the state, our death rate and hospitality rate is relatively small compared to other places in the country. Following San Francisco, the Bay Area declared it shelter in place back in March of 16. California as a whole declared it a few days later. The United States was short and lagging, and as you can see, even though we know that the US is more than 45 states, only 45 states actually declare that. You can argue whether it was a good decision or bad decision, time will tell, vis-a-vis actually also the Swedish experience, and see whether that was a right decision or not. That's not the objective of our presentation today. Real estate was added to essential services in April, 3rd of April, and we're going to see some impact on that on the market. And back in this week, California governor declared on California start relaxing those shelter-in-place restriction, and it does not apply to the entire state as a whole, but a segment of California. Obviously, the big question is, will we going to see a reoccurrence in the fall? I'm sure many of you heard some cautious warning, particularly from Dr. Fauci and their team, about the convergence of the flu season with the reoccurrence of the coronavirus. So these are some of obviously the unknown. So that's going to set up the background of what are we doing here in terms of timeline and so on. So let's now start going into the impact of the Silicon Valley economy on the real estate market. But before we dive into that, I want to take a minute and, first of all, what is Silicon Valley? More than actually a real physical place, Silicon Valley is more of a state of mind than really an exact physical place. But nevertheless, though, when we're talking about Silicon Valley, what do we really mean? So first of all, Silicon Valley, as we know it today, is 5 counties. And I'm mentioning today because when I arrived to Silicon Valley back in 1985, Silicon Valley was considered to be only Santa Clara Valley, County. And what we're seeing today, that it definitely expanded beyond what is the Santa Clara County, and it includes particularly most vividly San Francisco, which was added recently with the flood of startup and new young high-tech professional moving to the city and so on. So in addition to the physical place, we are discussing 4 employment hubs. And these are the San Francisco, Peninsula, South Bay, and East Bay. And we also look at our economy not as a homogeneous economy, and that is a very important component, because as we move forward in the presentation, you're going to see that the different economies play a critical role obviously on the economy as well as on the real estate market. So the most critical economy that we have in Silicon Valley is the established innovation industry. And we have something which I'm going to touch in a few minutes about SV150, which is the 150 largest publicly traded company headquarters in Silicon Valley. I'll touch it in a minute. But number one is the established innovation company. And obviously, most of you, if not all of you, are always familiar with those names. Then we have the startup innovation industry. This is an industry which is basically always kind of the future of Silicon Valley, the new technologies that we have seen from the famous Google and Facebook and so on, which basically always fuels the next round of innovation in our area. And of course, we have the support industries from government, healthcare, retail, food, and so on. These are all essential industries in our region, because without them, we cannot have a normal life, okay? We cannot live without having doctors, teachers, fire people, policemen, and so on. These are essential industry, but I call it a support because really what drives our area are these 2 industries. And the rest of the industries here are typically to support that that's the established industry and innovation industry in general. So if we look at the area in general, okay, if we look at this area, what do we see here? It's our area in terms of size, in terms of population, in terms of jobs, okay, average annual earning. When we look at this kind of number compared to the US, which is roughly about 60,000 plus minus, we see that definitely this is an area with a lot of potential earning. And obviously, we also see that the cost of living is obviously very high. Another interesting part is these two elements, okay? This is the net foreign immigration and net domestic migration. We see more and more that this area is becoming an area with a very homogeneous demographics, which is typically very highly educated people, very young people, high income. And we see, unfortunately, a lot of people who are probably born in this area, born and raised in the area, cannot live or stay here because the cost of living is so high. So this is one of the unfortunate things that we do see in our area. So Silicon Valley is prosperous and decline as a function of how well the local innovation-based companies are doing. And that is a very, very important thing, okay? Very important. We cannot continue to maintain this lifestyle if it would not be for those high-tech companies that are generating incredible amount of revenue in our area. There is absolutely no question about it. What I believe in general and follow as a consequence is that the Silicon Valley real estate is a derivative of the local economy. And as such, basically, I believe that the leading indicator that we have to follow is not when we are trying to understand what's going to happen in Silicon Valley real estate, is actually business indicator like the Silicon Valley 150, which as I mentioned, the index that's for the largest company located headquarters in Silicon Valley. And when we're looking at the startup industry, we have to follow the other elements of the leading indicator for the startup industry, from the joint venture Silicon Valley IPO to VC angel funding, M&A, and all that kind of stuff. This is, for me, was and is the leading indicator when I'm trying to understand what's going to happen in the near future and long-term future in the Silicon Valley real estate. And as such, I want to share with you some of those kind of incredible, impressive numbers that we are experiencing here in Silicon Valley, okay? So what do we see here? We see here that as far as I'm going to have an updated, this is a 218 number. And what I want to share with you is that if you look, even though we're talking about 150 publicly traded companies, 20% of those companies are responsible for almost 85% of the revenue of Silicon Valley, okay? 20 companies are responsible for 85% of the Silicon Valley gross revenue. And what we're looking at, if we look at here at the bottom here, okay, we see that Silicon Valley top 20 companies are generating about 880, almost let's call it $885 billion of revenue. And these are 18 numbers. The numbers for 19, I've not finished doing the summary, but they are at least 10% to 15% higher. Compared to the US, the generating 20.5 trillion in 18, we are generating about 800 and almost 900 billion, almost $1 trillion, which is basically 4% of the GDP of the United States. And something which I'm sure some of you know, California is, if California would be an independent state, it would be the 6th largest economy in the world. If Silicon Valley was an independent state, it would be the 17th largest economy in the world. And if we look at those numbers compared to number of employees, so 0.75% of population is generating almost 4%. If we are looking not only the top 20, but we're looking at the entire 150 companies, we are seeing that we're generating 1.1 trillion, which is about 5.4 of the gross GDP of the United States. And that this is excluding the fact that we're not counting about $52 billion of startup money, and we do not look at companies which are headquarters outside Silicon Valley, whether it's Amazon, Microsoft, Samsung, and so on. So the bottom line here is Silicon Valley is an incredible engine of innovation and growth and a significant economy. There is second to none in the world. If we're going back to the leading indicator that I mentioned before, and the reason I'm looking at the stock market as a leading indicator, because anyone who follows the stock market knows that basically, in general, analysts do not care about how the companies perform in the past. They care about what is the forecast for the companies to perform in the future. So that is why I'm tracking the stock market of those companies as an aggregated, is the Silicon Valley 150, as an early indicator, leading indicator of how our region will perform. So if we look at this chart from beginning of February, before the corona crisis hit us, we see a very significant growth. And what we see here, that you see the Silicon Valley companies are outperforming the S&P 500. And those who are not familiar with the S&P 500, which is basically the index for the largest 500 companies on the US stock market. One thing which you should not forget, so very much we see here that the Silicon Valley companies are outperforming the stock market. Something which we also shouldn't forget is the fact that actually the S&P 500 has about 23% in its index high-tech company, which is a lot of them are Silicon Valley companies. Some of them are not, of course, like IBM and Microsoft, which are not based in Silicon Valley, but nevertheless, though, are benefiting from the technology, whether it's IBM and Microsoft and Amazon. They are part of the index, but they are not local here, but they are basically giving us the trend. So in other words, what we're seeing here, that the technology actually, not that it's outperforming only the S&P 500, but it actually helps lift the SPY, the S&P 500. And we clearly see that the market see this industry as an industry which is significant, as a significant impact on our economy, or on our economy in the future. And when we move now to the startup industry, to the innovation industry, the next generation, the future of Silicon Valley in terms of innovation, of course, not all innovation going to be only in startup. We know that Apple, Google, Facebook, and other companies, and Tesla and so on, are continue to innovate. There's no question about that. But nevertheless, though, this is an industry which has a significant part in our economy, and obviously we have to look at it. So what we see here, this is from the Index 220. Basically, it looks at 2019, and what we see here, venture capital investment, we see that venture capital investment actually start dropping already last year from the previous year. If we look now at angel investment, which typically is a more higher risk investment, where we do see smaller amount. Nevertheless, those companies that are early stages, we also see some downward trends also starting from previous year. And obviously we see actually from a year earlier, a little bit also a reduced investment level. So what we see here, this is another very important chart, and it basically look at the general employment of Silicon Valley. And Silicon Valley basically looks at our employment in 3 tiers, okay? We see the tier 1, which is basically, this is tier 1, which is basically the high skill employees, high skills, high wages. We have tier 2, which is basically the red one. And these are, see, the largest one, tier 2, mid-skill, mid-level, and the low-skill level, tier 3. So I want you to, and we're going to come back to this chart to make sure that you see how those employment levels fluctuate over time and are impacted by the different economic cycle that Silicon Valley is going through. So now we're going to talk about the prior to COVID-19, the real estate. Let's talk about the real estate market prior to COVID-19. So what do we see here? This chart shows us the Santa Clara, for the Santa Clara County, median price and average price. And I like to follow those, the median price and average price, as a long-term trend. Obviously, and we're going to discuss a little bit down the road, it does not give you a good indication of a particular area that you might be interested in buying. Because obviously you do not buy in the median or average price in Silicon Valley, you buy in a particular neighborhood that fits your profile, needs, and so on. But nevertheless, the medium gives us some kind of a direction of what's happening in the market. So we have the average and the medium, and obviously the reason we have such a discrepancy between average and medium, because we can find homes in Santa Clara County that are maybe priced at $500,000 to $800,000 on one hand, and then we go into areas like Palo Alto, Los Altos, Woodside, and Atherton, and so on, where you can buy homes for 15, 20, 30 millions and above. So obviously we do see a discrepancy between these two. Another thing that I want you to look at, which is very important, is the fact that a lot of the appreciation typically happens in the first quarter. Okay, if you look at here, you look here, you look here, there is a sort of a trend of the market. Appreciation, most of the appreciation from a timing perspective is happening in the Q1, Q2, and then kind of the market flattens. Okay, so watch that. As we move now to the sell volume. So the blue one, okay, this is the supply, and this is the sales. Okay, and what we see when we follow the market, that the market has some cycles in it. Okay, is you look at that, obviously we have here the low, this is the low inventory and low number of sin. Inventory picks up toward the summer, drops back again toward the next end of the year, and this kind of pattern keeps repeating itself. Okay, and if we look at what happened back in 2018, if you remember in the Q4 of 2018, the Feds have started increasing the interest rate, and what we saw is basically a drop in the sales, while we saw an increase in the inventory. And we see that actually increase going to the beginning of next year. And if we look at the prices, what happened, we see the appreciation here, but clearly we see the drop in the prices at the end of 2018, and we saw some pickup at the beginning, and again in the flat. So basically we see that the market has cycles, which are basically depends on the time of the year, but we also clearly see the dependency between prices, interest rate, basically the affordability of people to purchase a home in their target area. And obviously, when we look at another indicator, which is basically the relation between the sales price to list price, we saw here a major drop. This is a 2018, where major drop we see in the relationship between sales price to list price. And we saw the beginning of 19, which we're going to talk in a few minutes, is a pickup. And I can tell you that the beginning of 2019 was a very strong beginning for us. We saw the year started between January and kind of end of February. We've seen a very strong start. We went into a lot of transaction. We have seen competition. We've seen prices going up and so on. Definitely, no question about it. And as we look at the basically a ratio that we are tracking, kind of seller market versus buyer's market. So again, 2019, we start seeing market is moving toward in favor of buyers, but then we also saw the market is basically moving back in favor of sellers. Okay, so what we want to look now at is the affordability. Affordability is a critical parameters that measure the relationship between the median income to median price house, given a cost of capital at about 20% on a 30 years loan. This is an indicator that gives us, again, a general trend. It's not really fully accurate and applicable for everyone, because one of the things that this index, affordability index, is not taking into account is the fact that not necessarily every person who lives in the county is in the market to buy a home. A more accurate index would have been one that actually measured the affordability of those people who are in the market. Okay, so not people necessarily who are retirees or in the early career, but what is the affordability rate of those who are really in the market to buy a home? And I believe, and obviously this ratio is much higher, because if anyone of you is aware of any of the requirements to obtain a loan these days, it will be very clear to them that most of the banks would not lend you money if your debt to income ratio is above 43%. So basically, there is some discrepancy to that, but the actual lending actually would not allow you to, as I mentioned, the lender would not lend you money unless you, for the particular house, a particular down payment, if your debt to ratio is over 40%. So what do we see here? So we have here obviously the San Mateo County, we have the Santa Clara County, and what we are here today, interesting enough, as we see here in this area, that our affordability went up. So how in the world can that be if we know that prices are where they are, and nobody, as I am aware of, has received a major pay raise in a very short time? So the explanation for that is very simple. What we have seen as of, if you remember, 2018 that we talked about, where interest rates went consistently up, and basically this is December 24 when the Feds reduced the rates and it dropped from about 5+ to roughly where we are today, around 3 to 3.25. And if we talk about adjustable rate mortgage, we are already touching 2.5, 2.6. So clearly, the main factor that helped this kind of recovery that we're seeing here is the fact that interest rates were reduced significantly. So on the demand side, obviously this is the supply side. Now let's talk about the demand side. So what we're seeing here, that we still have a very strong demand. So if you look at this chart that basically follow the relationship between increase in jobs, okay, to increase in available housing. And this gap is basically shows us the shortage, the shortfall of the available housing that is available in the area. So obviously, the larger that gap is, the more there is a demand. And what we're going to see very shortly, that is actually depends on various cities. So if we look at that part, look at San Jose compared to San Francisco, that has a very significant gap. And we move to Sunnyvale, also a significant, and Santa Clara, they also have a significant one. And we go to Redwood City and so on. So we see a lot of those areas that we have here have a strong demand. And the demand, obviously not everyone who moves and start working in this area is in the market, but nevertheless, though, you see clearly that there is a strong demand for housing in our area. So yes, not necessarily everyone is looking to buy a house, but everyone has to live somewhere. So it's either this demand is for new housing, whether you buy one or you have to rent one. That is clearly an indication. And if we look at other cities that we have here, Menlo Park, also we have a significant impact. And we look at Los Altos and so on. And I want you to look, remember the cities, Saratoga, Los Altos, Palo Alto, Cupertino, Sunnyvale. When we're going to talk about another element of who are the people going to be impacted in different areas, okay, given the tier 1, tier 3 that we spoke about. So we're going to get back to that a little bit later. So in summary, this first segment, the Silicon Valley real estate, Silicon Valley economy and real estate market prior to COVID-19. So how can I summarize it? Economy performed very well. We have seen the index that, as we talked about, as the leading indicator for myself, as a very strong indication of what's happening in the market. We have startup funding was trending downwards already before the COVID-19. So that's, we're going to see down in a few slides that it actually just accelerated. We see a real estate market respond to a strong tailwind, okay, from high stock market, lower interest rate, and low inventory. These are the three factors: stock prices, interest rate, low inventory, resulting obviously in higher buyer interest, more competition, higher sale price to list price. And obviously, these are the result of that. Nevertheless, though, there are, and there have been already for quite some time, people who believe that Silicon Valley and the financial market was in a bubble. In our typical seminar, I have a segment of what is a bubble. I spend more time in that, and I will be more than happy to take it offline, or when we talk more about it in the seminar, more detail, I'll be able to share it. But in general, the question of bubble, whether it is a bubble or not bubble, is not a simple one. And I can tell you that prior to the COVID-19, in my humble opinion, based on this criteria, which I'll be happy to share with anyone, is that I do not believe that Silicon Valley was in a bubble, at least not at that time. And with that, I would like to open it for about 5 minutes of Q&A. Please ask questions, open your mics, and I'm here to answer any question you have.
Avi, what is the impact of the tax changes from 2018 on the demand?
Excellent question. We basically, obviously, the Trump tax was not as significant impact as many have thought it will. It impacted particularly our area because for two factors. Number one, they excluded the deduction of property taxes for people who are making certain money, number one. Number two, they reduced the deductible interest on mortgages up to $750,000. Number three, they removed the deduction of $100,000 deduction of a home equity line of credit. So those factors, eliminating the property tax basically, or actually limiting it to $10,000, including state and local taxes, reducing the deductible of interest, which used to be until $1 million to $750,000, and the elimination of the home equity line of credit had an impact, but much less than we anticipated. So we saw some slow market during the 18-19, but we saw a very strong pickup in the beginning of 19. Next question. Questions? Asaf, are there any questions on the?
I have a question.
Yes, please.
Okay, I was noticing that the sales to listing ratio spiked between about mid-17 and mid-2018. Can you explain that? And can we expect something else like that in the future?
Well, obviously, anytime we see a spike in the ratio between list price and sell price, it can come from a few factors. Number one, which is the least one that I like, is when agents are underpricing the house below fair market value. There are quite a few agents that are basically underpricing the homes and sometimes 20-30% below fair market value. And they do that because they want to create some rush, they want to create competition, and they basically are not pricing in the fair market value, giving the illusion to some people that it's a steal and you should jump to that. That's one of the ugly part of this business, which I don't appreciate very much. The other explanation to that is, which is a genuine one, which is we see consistently a drop in the volume of homes offered to sell. At the same time, we see, and we saw before, an increase in the demand, coupled with the fact that we have people working in the high-tech business and their stocks are doing very well, and the fact that the interest rate dropped. So we see a demand basically coupled with affordability that's created that kind of a competition. Was that a...
Yeah, I think so. I'm just not quite sure why it happened between mid-17 and mid-18 specifically. Was there some trigger, an interest rate change, or?
Yeah, there are some parameters. We can dive deep into that, but that's typically what's happening.
Thank you.
Next question.
I'll ask another one. I've heard some crazy talk about interest rates dropping like crazy, and special loans being given due to the pandemic. Do you think there's anything to that? And
we're going to talk about interest rate a little bit later, but actually today lending is becoming much more complex than it ever was before. We're going to see, we're going to talk in the during section about that. So I'll talk a little bit more about it later on, if you don't mind.
Thank you.
Okay, so last question before we move to the next segment.
You can type in the chat if you'd like to.
I have a question about the affordability. Can you explain more about the meaning of that? Like, we saw a percentage there, but is that average income and average?
Very good question.
Right.
Thank you.
Yeah.
So first of all, let's define affordability. Affordability is the relationship between the median income to the median house price, taking into account the cost of capital, with 20% down for a 30 years loan. So if they look at the median income in the county, for instance, and then they look at the median price house, and they know what's the interest rate, and they say, with 20% down, given today's interest rate, what is the percentage of people who can afford buying the median house price?
I see. What's with the debt to income rate?
So it's a ratio between house price to an income given the cost of capital. So the higher the number, it means that more people can afford buying. The lower the number is less people can afford buying. But what I also said, that is why it gives us a general indication of the market. It's not telling you a true story, because what we have to measure is the affordability of the people who are in the market and buying, not necessarily people who are retirees and don't make any money anymore, or basically just graduated from school and start working. So it gives you, though, a general indication of the ability of the local population to participate in the real estate market, given those financial conditions.